Equity markets should be relatively strong next year, just with less significant gains and at least slightly more volatility than this year. If you look forward into next year, you're already starting at peak multiples since the crisis. You're around 18 to 19 and a half times forward earnings. So it's unlikely you get further multiple expansion. And if the Fed is forced to hike rates more aggressively or interest rates go up higher at the back end of the yield curve, you could see some multiple compression. So that's not a positive, and it could be a slight negative. That being said, given the strength in the economy and the expected strength in revenue growth, we should have another reasonable year of earnings growth, somewhere in the high single digits to low teens. So our expectation would be for equities to be up high single digits to low teens next year. Now, in terms of bonds, one of the conundrums that is challenging capital markets is to understand why, despite multiple Fed rate hikes, despite much stronger growth, not only in the U.S. but abroad, interest rates remain very low in the back end of the curve. We think a large part of this is still due to extraordinary loose monetary policy overseas, particularly in Europe and Japan. The Fed is gradually winding down their balance sheet. So we do expect bond yields to go at least slightly higher next year, which will lead to not a terrible environment for bonds, but a more challenging environment for bonds. It won't be as bad as the 3 to 6 months after the election, but it won't be as good as this year. So we see, Barclays Ag somewhere down 1 to up 2 next year. Now, how does this all affect SkyBridge? So, for us, our mandate is to generate the best returns we can with as low risk as possible, and to do it in a way that's different than equity and bonds. So we're more focused on making money in different ways than equities, but still focused on a strong economy powering our returns. So instead of being exposed to corporate assets like equities or corporate bonds, or fixed income assets like U.S. Treasuries or U.S. mortgage-backed securities in terms of the agency market, we're focused on assets that are tied to real estate, commercial real estate, the financial condition of regional and community banks, which we think continues to improve. So what we think will happen is both equities and SkyBridge will do well from economic growth. However, if we're wrong and the economy struggles and markets have a tough time, we think we'll have far less downside.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.